Welcome to the MultiTrader Smart Money Concepts Trading course. The topic today is smart money concepts. And at the end of the event, you are going to learn about smart money and its power in making better trading decisions used by the big players. Discover 8 strategies used by the top 7 smart money players. Understand liquidity and spot 5 levels of liquidity and liquidity sweeps for your trading and why it's important for smart money. Learn and master order blocks, break of structure, change of character, fair value gaps, equilibrium, and find the daily basis to know the future and unlock when to buy or sell the market. Master the 6 main elements of smart money concepts and use them to improve your trading strategy and put the newfound knowledge into action with real-life SMC examples. Smart money concepts. SMC is a more sophisticated method of price action to spot, identify, and locate where smart money is buying and selling their positions. In other words, we use SMC to make better and more informed trading decisions based on what the big boys are doing. What is smart money? Smart money are the big market movers. They use capital, highly invested capital, by the smart, informed, and savvy financial institutions. Now, this capital and their contract sizes are large enough to drive the market. And they use different strategies and methods to achieve superior returns in the markets every single day. They're the big contrarians. So they look for huge orders where retail traders' entries and stop losses are, in order to enter into their own positions, which go in the opposite direction. When there is buying volume from the retail traders, or what I say, dumb money, we have smart money that sells into those orders. So if there is a large volume of buying from retail traders, smart money uses these levels to sell or go short. When retail traders sell their positions, so there's 2 ways. First things, short sellers sell their positions to get into the market. All right. Smart money buys from their selling positions. The other way is for people who are long in the market, they get stopped out. So remember, they bought low and they sold high. Where they sold high is where smart money buys. So if there is a large volume of selling from retail traders, smart money uses these levels to buy or go long. Retail traders sell to go short and buyers stop losses. Smart money buys and goes long. All right, so what that means is what? At this point over here, retail traders either go short or the buyers get their stop losses out. At that point, that's where the big boys come in and buy and go long at that level. So this is where the retail traders say, my stop loss got hit, and then it just went straight to my take profit. How many times have you heard that? SMC, who is smart money? So these guys are the hedge funds. They are the private equity firms. They are the investment banks. They're the big banks. They are the market makers. They are the asset management companies, and they are the mutual fund companies. Strategies from smart money and what they use. So what strategies does smart money use in order to allocate where to buy and where to sell? The first one is fundamental analysis. They evaluate and base buying and selling decisions on a market's health, revenues, micro and macro analysis, as well as the price ratios. Then there's technical analysis. Technical analysis are the indicators, the price action, the volume strategies to find market trends, price patterns, areas of liquidity, accumulation and distribution. The next strategy they use is quantitative analysis. So they use a large amount of data to look for price correlations, patterns, and they make probabilities through it. Then there's growth investing, where they focus on finding and investing in high growth, high capital companies, markets, or sectors to generate strong returns. They also do value investing to find undervalued companies, currencies, and markets that show strong potential of growth in the future. And then they use arbitrage to find opportunities in buying and selling securities simultaneously in the markets to profit from the discrepancies of prices. They also use hedging strategies. So this is to reduce their risk exposure by buying or going long and selling or going short different markets to offset potential losses, generate returns through dividends and interest income. They also do high frequency trading to generate quick and large returns through buying and selling high speed trades, which they use powerful computers and algorithms. This is also done on an intraday basis where they take advantage of fast market swings, trend changes, and anomalies. Liquidity explained. This is a big topic. Liquidity is the degree, rate, and ability for an asset or security to be easily bought or sold in the market at a specific price. So in other words, it's the ability to flow in and out of positions easily and without a large price move change. In other words, the high liquidity, the easier it is to flow into their positions. They don't want to take positions in 6 to 10 different orders. They want to get in where the high volume is traded at, okay? Smart money and liquidity. Why high liquidity is important for smart money. So first thing, it's quick. They wish to enter and exit their positions quickly and gives them a better chance of adjusting their positions if needed. There are less costs. High volume in the markets mean that they can enter into their positions in less increments. This means less transaction costs, brokerages, and slippage. Less manipulation and risks. They want to get into high liquid and top markets because there is less chances of price manipulation. They avoid markets that can be swung due to crazy price moves. Better risk and money management. So high liquid markets for smart money makes it easier for them to manage their risk better. This way they can control their positions, entries, stop loss, and take profits along with their volume they trade with. Now, there are two types of liquidity. Sell-side liquidity. This is the area of prices where smart money players buy large quantities of assets without significantly affecting the market's price. So when you see sell-side liquidity, think about retailers. These are where the retail traders are selling or going short or getting stopped out if they are long, okay? So I'm going to read that again. The area of prices where smart money players buy large quantities of assets without significantly affecting the market's price. How do you spot sell-side liquidity? It's a price area on the charts where retail traders will most likely have their stop losses in place for traders who are long and buy. Smart money will come in and sweep the liquidity, getting them out, okay? Their entry orders in place for traders who go short or sell. So let's look at this with sell-side liquidity. So we can see the market comes down, correct? This is called sell-side liquidity. This is where the market's coming down and the shorters in the market want to get in because they believe that the price is going to continue down. The market's also coming down, and this is where those who went long, so if they went long at this price, then the market turned and carried on going down. This is where they would what? They would get stopped. So there are a lot of sell orders coming within this area of the sell side liquidity. Then what happens is smart money comes and they sweep the liquidity. So long buyers are stopped out, they sell their positions, and shorters enter into their positions. Smart money buys into their sell positions. Before I carry on, I want to now talk about liquidity sweeps. So what is a liquidity sweep? It's also known as a liquidity grab or a stop loss hunt. So a liquidity sweep is where smart money look for liquidity levels in order to enter or exit their trades easily, quickly, and at lower costs. Once they enter into their positions, we say liquidity has been swept. So let's go back to sell side liquidity. What happens once smart money buys at sell side liquidity levels? We say sell side liquidity from retail traders who sold or shorted has been swept, and markets will tend to reverse in trend to the upside. What happens is there's now higher demand because smart money has come in, they've swept the liquidity, they've bought into the sells, and it pushes up the price, correct? Because there's low supply, there's higher demand, and it leads to a higher price. So initially, you can see if the demand is high, there is less supply. If supply is high, then there is less demand, which means that they push the price up. So there needs to be a new demand curve to push up, which brings up the price high. Basic economics. So let's bring back this chart and say, all right, so now there's sell side liquidity. The guys get in at this level. They see the perfect buy entry. So they buy, and the market crashes down to certain levels. This is where sell side liquidity comes in, where the shorters now get in. They say, no, this market is coming down. The long guys who went long here get hit with their stop losses. And that's where smart money comes in, sweeps the liquidity, and you can see the price then rallied on up. All right, so sell side liquidity box is drawn. This is where smart money comes in, and you can see the price rallied on up. Let me repeat this because this is probably new information to most traders. They buy in at levels, the guys who go long. The market comes down, stops them out. This is where short sellers get in because it breaks levels of, well, levels of liquidity. And then because smart money bought into their sell position, they swept liquidity and the market rallied on up. Now let's talk about buy-side liquidity. So what is buy-side liquidity? This is the area of prices where smart money players sell large quantities of assets without significantly affecting the market price. So remember, when I say sell-side liquidity or buy-side liquidity, it means that when you see buy-side liquidity, it's retail traders that are putting in the buy orders and the shorters who are getting stopped out, which obviously when they sell a market, they have to buy back the market, which gets them out. That liquidity, or buy-side liquidity, is where the big boys come in and sell. And we say buy-side liquidity has been swept. So how do you spot buy-side liquidity? It's a price area on the chart where retail traders will most likely have, one, their stop losses in place for traders who are short sell. Smart money will come in and sweep the buy-side liquidity, getting them out. Two, their entry orders in place for traders who go long. So when people want to buy and enter into their trade because they go long, when there is a buy, there's a sell. So buy-side liquidity, you can see it's the higher levels. We have the markets that have come down, okay? And the shorters short at these levels. They say, you know what? This market is coming down. We're going to short. So They short, the market goes up, and at this level, they get stopped out and they buy back into their positions. The long guys, and this kind of includes me, not fully, but it kind of includes me. However, we would have gotten out long ago because we would have had our cup and handle broken up, market went up, that we would have put our stop loss in place and locked in a profit. But at this point, some guys who believe, all right, this market is just going to continue going up, they would have missed 90% of the move. So they get in at those levels. Smart money comes in and sells into it. So they sweep the buy side liquidity. So what happens once smart money sells at buy side liquidity levels? We say buy side liquidity from retail traders who bought has been swept. Markets will tend to reverse in trend to the downside. So high supply, lower demand leads to a lower price. The supply changes, and we can see that the supply becomes a higher quantity and the price becomes lower, which brings the price further down. So here is the chart again. The buy side liquidity has formed. The short sellers have been stopped out because they had to buy back their positions. The long buyers enter into their positions, and smart money comes and they sell into these positions, and it brings the market down. Okay. We say buy side liquidity has been swept. Levels of liquidity. So what are levels of liquidity? I like to say LOL, like laugh out loud. It's just easier to write. So levels of liquidity is the area of prices where smart money players identify and choose to buy or sell large quantities. So the first level of liquidity is support and resistance. They look for prominent levels of supports and resistances. So you can see a support line forms, there's sell side liquidity. The market moves up because smart money buys into support levels. Then there is a level of resistance that creates buy side liquidity. Smart money gets in and it causes the markets to crash. So the first level of liquidity are prominent supports and resistances. Now, if you remember from my previous courses, that with supports, I always look at least 3 touches on a support or floor level, or 3 touches on a resistance or ceiling level. Okay, so that's the first level of liquidity. At support, smart money buys. At resistance, smart money sells. Isn't this a chart pattern? And I can say, yes, these are the times when there is consolidation within a range of buying and selling. And you'll notice that I wait for breakouts to take place in order for the trend to establish. But during these ranges, there are opportunities that you can take advantage of. And that is with sell side liquidity and buy side liquidity. You will be able to see now, because of these levels of liquidity and where the orders are actually coming from. Sell side liquidity from retail traders is swept by smart money. There is a low, there's a high low, high low, high low, same low, low. So 1, 2, 3. Only once you're at this point of your trading, or even at this point, you will notice, okay, there is a sell side liquidity level with a support. So at this point, that is quite prominent, long buyers get stopped out. Why do they get stopped out? Because they put their stop losses anywhere between these levels. Smart money comes in and sweeps it all. It's not just individual levels. The wicks are the smart money players that are trying to sweep the liquidity, as you can see here. The short sellers also get in at those levels. So this is on a daily time frame, and some short sellers get in on 5 minutes, 10 minutes, and they say, nope, this market is coming down. It's broken a massive support. We are getting in. So smart money buys at this level of support or level of liquidity. Then there are resistances. So buy side liquidity from retail traders is swept by smart money. So we have 1 touch, 2 touch, 3 touch, 4 touch, all right? So you can draw this box and you can say there is buy-side liquidity at these levels. This is where short sellers are stopped out, which means they have to buy back into their positions, and the long buyers enter into their positions, and unfortunately, they also get stopped out because the market turns, because when they were buying back their position, smart money was selling. So smart money sells at resistance. Then we have the next level of liquidity, highs and lows. So they look for the most recent and prominent levels of highs and lows. So there's a high here, a high here, a high here, a low, a low. So they look for these kind of levels. The third level of liquidity are key levels. Smart money identifies key and psychological levels. There is a buy-side liquidity where the retailers are buying and smart money is selling, and there's sell-side liquidity. The dumb money or the retail traders are selling and smart money is buying. All right. So what do we see here? There are key levels. The key level that we're talking about is this level of 7,000 and this level of 8,000. In this case, it's a round number, and that's considered a key level. Other key and psychological level is Fibonacci pivot Gann levels. 200-day SMA, probably the most important level of all. When prices above 200 moving average, there's buying and it's in an uptrend. When prices below the 200-day moving average, there is selling and it's in a downtrend. So that is a key level. As you know, my levels are 721 for just momentum, and then 200-day moving average for the actual trend. Are we in an uptrend or a downtrend? When the price goes up and down between the 200-day moving average, we say it's in a range bounded area. You draw your box and you just completely ignore it, because indicators do not work in range bounded movements. The other key and psychological level is Bollinger Bands, highs and lows. So as you know, Bollinger Bands are based on a moving average and then 2 or whatever standard deviation above the moving average or below the moving average, and it acts as an elastic. So when the price goes above a certain Bollinger Band, it is more likely to move down to the middle to rebalance and claim equilibrium. And when it goes to the bottom of a Bollinger Band, it tends to turn around and move back to the moving average. But we'll save indicators for another day. Then there are round numbers. As I mentioned, 8,000 and 7,000 is clearly a round number and clearly a level of liquidity that smart money wants to stop people out. And then there are 52-week highs, lows, supports, and resistances. So what is 52-week? A year. Just take a look at the year, take a look at your chart and say, where are the highs, where are the lows, where are the supports, where are the resistance, draw them up. The fourth level of liquidity are trend lines. Smart money buys and sells above and below trend lines. So when there is a downtrend and the price breaks out of a downtrend, we say that there is sell-side liquidity where smart money is buying into those levels. The smart money buys above the downtrend. They get in at those prices. Then the market moves up. We can see there's higher lows, higher lows, higher lows. Then there's a break in the uptrend. And this is where there is buy-side liquidity, and smart money sells into this liquidity. So where retail traders are basically getting stopped out for those who went long, that's where smart money sells. Okay, something very interesting. How do you remember that buy-side liquidity is up and sell-side liquidity is down? It's unprofessional, but I like to say it's BS. Buy-side liquidity at the top, sell-side liquidity at the bottom. It's just a way to remember. So remember BS. Then we have the fifth level of liquidity, and that is the traders' stop losses. So they look for high volume orders of retail traders in order to enter or exit out of their positions. When there is a median, so you can place a median indicator on volume, when there is a spike in volume, we can say that this is where smart money or big guys are coming in and they're sweeping liquidity. So in this case, they're sweeping liquidity on the sell side to buy into it, so the price will move up. Short sellers enter into their position, so they sell because they believe that the market's going to continue down, And long buyers get stopped out and they sell their positions because they need to get out of their positions. Smart money comes in, sweeps the sell side liquidity, and price moves up. So that's the fifth level of liquidity. In summary, the 5 levels of liquidity at prominent supports and resistances, at prominent and recent highs and lows, at key levels or psychological levels or round numbers, above or below trend lines, and traders' stop losses, for example, high volume traded around those prices. SMC order blocks. So what are order blocks? Order blocks is an area where a huge amount of volume of buying or selling was executed. So this normally causes a market reversal or for the market to reverse in the trend. So in other words, there are large market orders or big block of orders where smart money buys or sells within a price range. These are their areas of buying demand and selling supply. So there are 2 types of order blocks. Let's start with a bullish order block. This is known as a buying or a demand zone for smart money. Bearish order block is known as a selling or a supply zone for smart money. It's our job to find these order blocks and act off of them. So let's identify the order blocks. You'll normally see an order block when there is a sweep of liquidity and you see an expansion in price to the upside or downside. So there are 6 ways to spot order blocks. High volume, abnormal and significant volume at certain prices, which we've spoken about. Rejection, so supports or resistances, highs or lows get rejected on weekly highs or lows. They get rejected. That's an order block. Key levels, which are levels of certain prices, psychological, round numbers, Fibonacci, Gann, pivots. Candlesticks, so certain candlestick formations, for example, engulfing candles, dojis, shooting stars. These are all levels of order blocks. Market structure break. If you see a break in market structure, for example, break of structure or change of character, news event that causes a shock in the market's price, such as NFP or FOMC. So now we're going to go into the market structure shift. Market structure, in a nutshell, shows you what a market is doing, which direction it's in, and where it is more likely to go. So we have an up structure, which is when the price makes higher lows and higher highs. Those are called up structure candles. So an up structure candle, and so on. A down structure is when the price makes lower lows and lower highs. We say these are down structure candles. A market structure shift shows you when the price is breaking a structure or changing the direction in the market. So each following candle's close will confirm the market structure. So the question we need to ask is, do you use the wick or the candle? So you can choose. If you use the body of the candles, you're following the structure of a line chart, especially the close of the chart. So if we draw this, as you know, a red candle has an open and a close lower than where the open is. So follow the direction of the candle. So we got down, open, down, open, down, open, so on. Okay, then you got up, up, up. Then you got down, up. So if you learn to do this with the candles, you'll get an idea of where there is a break in market structure. If you use the wick of the candles, you're incorporating the entire market's price movements. So what do I use? I prefer personally to use the wicks. However, there are scenarios where I'll use the body instead or the previous wick. For example, price anomalies or shakeouts where the wick is abnormally large. So with these type of candles, they're very normal ranges, correct? So market goes up, down, up, down, up, down, up, up, up. But for example, this candle interfered and it was an anomaly within a certain trend. So we would disregard this candle completely. Just like on the outliers, when you do statistics, you avoid the outliers and you keep to the mean. The same with market structure shift. Break of structure. So we're going to talk about the first type of structure. What is a break of structure? When the price breaks above or below and continues in the direction of the trend. When the price breaks above or below and continues in the direction of the trend. It is not a reversal. A break of structure is with a continuation. More specifically, when the price breaks and closes below or above the previous wick of the previous low or high in a down or uptrend. When the price breaks and closes below or above the previous wick of the previous low or high in down or uptrend. So let's try and spot these. Think of a break of structure as a simple continuation in the overall trend. This is all going to make sense. When the price breaks and closes above the wick of the previous high in an uptrend. So that is what a break of structure is to the upside. So you have the market move down, up, down, up, down, and then it makes a new high. So we're using wicks in this case. So this here is the high in this case. So you draw a line when the price breaks and closes above the wick of the previous high in an uptrend. All right. We have a break in structure. So the market moves up, it makes a new high, and at that high, you draw the line. You then wait for the price to break and close above the wick, which it did over here, correct? So we say we have a break of structure to the upside. Then we plot the next high. So the market made a high over here, and you draw it. So your market goes up, down, down, up, down, and it never broke above this high. So you draw it. Then there is another break of structure to the upside because the price broke above the most recent, previous, and prominent high, and we use the wick. Then we draw another high, and we wait for the price to break above that high. Then we have a break of structure to the upside. Or you could move this line to above this wick. Then we have a break of structure to the downside. So this is when the price breaks and closes below the wick of the previous low in a downtrend. We look at lows with break of structure to the downside. So let's draw this out. We have a low, so the market comes down and forms a low, a low, a low, and then it forms a prominent and recent low, which we draw a line, okay, because the market turned up from there. So now we want the market to break below this low. So the market goes up and it breaks below, and there is a break of structure to the downside. Why is it a break of structure? Because it's continuing in the direction of the trend. So the break of structure to the downside is continuing. It then forms another low, which you draw a line. So in this case, I didn't draw this low. You would, once it forms this candle, you would draw that low. You would wait for the market to break, and then it closes below the low, continuing down. So we have another break of structure to the downside. Clearly, the market is in a downtrend, and there are break of structures to the downside. So here is an example of a recent chart, and I spoke about this with the break of structure to the downside. So you can see the market broke down, went up, we drew the line, break of structure, and it closed below that low, and there was a break of structure to the downside. Went down, made a low, draw that line, break of structure to the downside, break of structure to the downside. So what happens when there is a break of structure? It shows a potential entry, long or short. It gives an area where the price is most likely to return and sweep or grab or draw liquidity. And it shows a level of liquidity or a key level, and it creates new levels of support or resistance. So notice a break of structure is also a level of liquidity that smart money is watching. And obviously it creates new levels of supports and resistances. Now let's talk about a change of character. A change of character is when the price breaks above or below the overall market trend and changes direction. So a break of structure is where we had a continuation in the trend, and a change of character is where it changes directions completely. Think of a change of character as a trend reversal. So you can see there is a prominent downtrend, market breaks up, and somewhere over here there is a change of character. Then there is an uptrend, market breaks down, and then there is a change of character. So we're going to go into how it works. So what is a change of character to the upside? When the price breaks and closes above the previous downtrend. When the price breaks and closes above the previous downtrend, we have a change of character. So a change of character to the upside. There are a whole bunch of break of structures, as you can see. And you would always draw in your levels and you would wait for a break of structure to the upside, break of structure to the downside. And then when the actual trend changes, there is a change of character and a new trend establishes. What is the change of character to the downside? So when the price breaks and closes below the previous uptrend, there is a change of character. So the price goes up on an uptrend, as you know, higher lows, higher highs. The market is evidently in an uptrend. It then breaks. So in this case, it breaks. There's a break of structure to the downside, and there is a change of character that takes place, and then the market has reversed in the direction. So a break of structure, there is a continuation in the market trend, and a change of character is when there is a complete reversal in the trend. So when a change of character refers to a much larger shift in the underlying market trend, dynamic, or sentiment, this is where the price moves to the point where there is a change in the overall trend and it creates a trend reversal. So you'll see, and this is answering your question, you'll see change of character. Chart patterns work amazing with change of characters. So market structure break, break of structure versus change of character. A break of structure shows a break in market structure in the current trend direction, so continuation. And a change of character shows you a complete trend reversal where the price reverses and forms a new direction. Can you have a false breakout? Yes, with trading, with smart money concepts, with chart patterns, with anything, there can always be fake outs, there can always be shakeout. And you know what smart money sometimes does to stop out people who take smart money concepts is that they say, we didn't get enough orders. We're going to now turn back down. We're going to sweep liquidity even further down. And that unfortunately gets to the stage where we also get stopped. And that's why you can't just use a break of structure, change of character, a trend line for your entries. You need a bunch of confirmation signals that gives you a more likelihood that it's going to continue in the trend. And also, another thing that you want to do to confirm the trends that you're in is take a look at the daily bias. So daily bias, in a nutshell, this tells us which direction, trend, and environment the market is in and what we are looking to trade. We use longer timeframes to confirm the daily bias. Some use daily, others use weekly, some use hourly if they're looking at 5-minute and 15-minute charts. So let's look at a bullish daily bias. When the market environment is up and the trend is up, we look for long positions and buys in the market. When the market environment is up and the trend is up, we only look for long positions or buys in the market. So you can see there are higher lows. There's clearly an uptrend. So in this situation, we would look for buys and we would look for longs and we would look for sell side liquidity, sell side liquidity, sell side liquidity, and then run up with the market. A bearish daily bias is when the market environment is down and the trend is down, we look for shorts or sells in the market. How can you confirm the validity? Like I was saying, with validity, you need to look at different levels of liquidity. You also need to look at different confirmation signals. Maybe you're looking at indicators, maybe you're looking at chart patterns. But the validity is based on your strategies and your win rates. So no win rate is ever going to be 100%. And we need to identify how do we increase our win rate, but also increase the high probability trades. So with the bearish daily bias, we look at downtrends. We look at a high, then a lower high, and then another lower high. And we confirm that there is a downtrend where there'll be a buy side liquidity. You'll see a whole bunch of break of structures. So break of structure to the upside, break of structure to the upside. This is the next high, or we can even draw that one, but I would draw this line, break of structure to the upside. Then there is a change of character, and we then see the trend turn down. So you need to use confluence with time frames. So what I mean is that if the daily is showing longs, then on the hourly time frame or on the 50 minutes time frame, you will only look for longs. Sometimes the market looks so good for shorts, even though the daily bias is long, because there are times when you can go long in the market and then you would consider this, for example, sell side liquidity, come down, hit a stop loss, hit your take profit and then rally on up. But there are also times where you might get this as sell side liquidity, market comes down, goes back up and stops you out. So you need to go through the experience for trading. Bearish daily bias, you only look for short sells, the confluence time frame, so 1 hour, 15 minutes. The next concept is fair value gaps is the next important concept. A fair value gap is a 3-candle structure with an up or down impulse candle that indicates and creates an imbalance or an inefficiency in the market. These imbalances tell us that the buying and selling is not equal. Now, the market needs to rebalance to make up for the imbalance. So in this case, we can see there is a strong down impulse candle, and there is a fair value gap that needs to rebalance the candle in order for orders to be filled in the prices of the candle with a fair value gap. We're going to talk about a bullish fair value gap. So we have candle 1, candle 2, and candle 3. We then have a bearish fair value gap, candle 1, candle 2, and candle 3. How is the fair value gap constructed? There are 3 candles. First candle, so this is a bullish fair value gap first candle. This is the bearish fair value gap first candle. Second candle is the impulse candle up or down that forms a fair value gap. So the second candle, this is an up impulse candle. And the second candle over here, which is a bearish fair value gap, is a bearish or down impulse candle. And then we have the third candle, which is next to the impulse candle. All right. So the bullish fair value gap, third candle is this one here. And the third candle with the bearish fair value gap is this one here. How a bullish fair value gap works, we have the first candle, second candle, and third candle. The first candle, you draw a horizontal line from the top of the wick. All right. So here's the first candle, and you draw a horizontal line from the top of the wick. Then you have the third candle where you draw a horizontal line from the bottom of the wick. The second candle, which is the bullish impulse candle, you draw a box between the above and below, and you pull it over to see the fair value gap range. Here is your fair value gap. So you have 3 candles. The first candle, you draw a horizontal line on the top of the wick. The third candle, you draw a horizontal line from the bottom of the wick. And the second candle, you draw a box between the above and below, and you pull it over to see the fair value gap range. So between the candle number 1 and between candle number 3, they do not show common prices. That is where the gap is formed. They do not touch where the upper and lower wicks are. They do not overlap. So even though the second candle has orders filling within the first and third candle, between the first candle and the third candle, there are no overlapping prices. Hence, it's called a fair value gap. So we call a fair value gap a liquidity void within the market. So with a bullish fair value gap, we can expect the market price to move down. And why is that? Because we want the market to rebalance and fill in the orders that were not overlapped. So here's an example. That's not a fair value gap. First candle forms, wick goes up. Second candle forms, looks like an impulse candle. Third candle forms, but orders are filled within the third candle that overlap the first candle. You see that? So that is not a fair value gap. Between candle 1 and 3, the prices overlap. There is no imbalance. There is no inefficiency in the market. So the market does not need to go back and fill those orders to rebalance and go back to fair value. So with a bullish fair value gap, we can expect the market price to move down. So we can see candle number 1 forms. You draw your line of the top of the wick. Candle number 3 forms. You draw the bottom of the wick. You then draw a box that fills in the area that there is fair value gap. And you need to know that now the prices need to come back down and close or rebalance the inefficiency that's within the fair value gap, which is very often what it does. And notice here, another fair value gap formed within this range. So this fair value gap formed, price went up, there was buy-side liquidity, price came back down, swept the liquidity, filled the gap closed, rebalanced, and took away the inefficiency. How is a bearish fair value gap constructed? So we have the first candle, the second impulse candle, and the third candle. You draw a horizontal line from the bottom of the wick of the first candle. You draw a horizontal line from the top of the wick of the third candle. And the second candle, you draw the box between the low of the first candle and the high of the third candle. And that pulls in the fair value gap or the bearish fair value gap. Between candle 1 and 3, do not show common prices. They do not touch where the lower and upper wicks do not overlap. We call this fair value gap a liquidity void within the market. So with a bearish fair value gap, we can expect that the market price is going to move up, fill in those orders. So what is not a bearish fair value gap? So we can see first candle formed, wick formed, second candle, which looks like an impulse bearish candle, third candle, but the wick touched the third candle. So it did overlap. So there is no imbalance, there is no inefficiency, and the market does not need to fill those orders to rebalance and go back to fair value. So more or less, you will see the prices continue down. Does the fair value gap work on all time frames? Yes, they do work on all time frames. We do see 1-minute charts working, 5-minute charts, and 15-minute charts. With a bearish fair value gap, we can expect the market price to move up. So you can see there's a first candle, the second candle, there is an impulse, second candle. We then have the third candle where we can draw the fair value gap, okay, between the low of the first candle's wick and the high of the third candle's wick. Between that is the fair value gap. And we know that the price needs to come back over here, close the gap, rebalance, create efficiency. So now here are the questions that are quite common, and that is, how much does a fair value gap need to be filled? Price needs to fill at least 50% of the fair value gap to consider it closed or rebalanced. So you can see with this fair value gap, it doesn't need to close, 100% of the gap, but it does need to fill at least 50%. Question number 2, do fair value gaps always close and fill? And if not, why not? So the answer is no. And the reason is because, one, of price, where demand or supply of the market is stronger and doesn't lead to a gap fill. And you do often see that when markets are crashing at a tremendous rate. For example, this bearish fair value gap formed, and then the market didn't turn back up and close it because there was strong supply side that brought the market down. The second reason is news, where news data, announcements, or meetings can lead to a fair value gap to not fill. The third reason is micro and macro. So the inner micro and macro aspects of a market, security, or asset could result in the fair value gap to not fill. Question number 3, is FVG all you need to trade SMC? And the answer is definitely not. Like I was saying, you need to combine it with liquidity sweeps, combine it with break of structure, high, lows, chart patterns, and indicators if you use them. Equilibrium 50%. So now that we understand what a fair value gap is, we now need to know what is equilibrium, because when a gap fills, it is basically creating balance. And when you think of balance, think of equilibrium. So equilibrium is a state of the market where the demand and supply are in balance with the price. We say the price of the market is at fair value. 3 states with equilibrium: premium, equilibrium, and discount. What is premium? When the market trades above the equilibrium level, we say the price is at a premium or at a high price. When the price goes too high, it is more likely to go back down to the equilibrium price. So think about Bollinger Bands. When the price goes above the mean and it goes to 2 standard deviations above, and then the market needs to come back down because it acts like an elastic. Think about Fibonacci. When the market goes too much to a swing high, it is more likely to go back down to a 50% or 61.8%. Think of the Gann box. When it goes too high, it tends to come back down to 50%. So very similar to fair value gaps and equilibrium. How do we identify a premium price? Wait for a market to move in an uptrend at a high degree angle. Plot the swing low and swing high to identify the 50% Gann box or fib levels. The market's price above 50% is at a premium. Very normal, the market moves up. Step 2, there is a prominent swing low and a prominent swing high. So then what we do is we draw a Gann box or Fibonacci. And look, I'm not looking for any special 61.8% or 38.5% or any of that. All I am looking for is the 50% mark. So because this market moved up at such a high degree or such an inclination to the upside, you always do expect the market to come back down, sweep liquidity, rebalance, and then go back up or crash back down. So we're always looking for that because markets zigzag. The market's price above the 50% is at premium. That is what I'm trying to get at. So we can expect the price to drop back down at least 50%. And you can see that is what we did. So with a Gann box, and you can do this on TradingView, all you do is you plot a Gann box, take away all the other levels, just keep the 50% between the swing low and the swing high, and you can see what the 50% level is. The market comes back down and sweeps liquidity 50%, and almost like it's the elastic, just like the Bollinger Band, just like Fibonacci's, just like when the price is moving too high above a 200-day moving average. The same goes with when a price moves to such a high extent and then it needs some type of equilibrium or rebalance. Hence the word equilibrium, which is 50% of the move. And anywhere above 50% is called premium. Fair value gaps and premiums. So wait for a market to form a bullish fair value gap. Plot the first candle's high and the third candle's low to identify the 50% Gann box or fib levels. The market's price above 50% is at a premium. So the first candle's high, the second candle's impulse move, and the third candle's low. So this is a bullish fair value gap that is formed clearly. We can see the high, we can see the low, and between that is the fair value gap. But then between the fair value gap, you can draw your Gann box to establish where the premium is. So this is a bullish fair value gap. So you draw your Gann box in the fair value gap, you pull it across the entire market move, and you basically expect the market to fill within the premium at least, or to fill in the gap completely. So you expect the market to come back down 50%. So here's premium. We pulled the swing high and the swing low of the fair value gap. We drew a Gann box to create the 50% move, and we expected the price to come back down. So the price came back down into the premium section, swept liquidity, closed the fair value gap. Anywhere more than 50%, we considered the fair value gap closed. But because the move continued down, it went all the way, and it went to the first candle's market move before it went back up. So how does smart money work with premium? So here's premium and equilibrium. You draw your swing low and your swing high, and then you can see where does smart money want to buy or sell. So at the premium price of the swing low and the swing high, they want to sell their position. So what is this called? This is called buy-side liquidity. And why is it buy-side liquidity? Because retail traders or dumb traders are buying into these moves, okay? Or short sellers are getting stopped out. And when they get stopped out, they have to buy back their positions. So all those buying positions go to smart money, who are selling it to them, and the price comes back down to equilibrium and within the premium range. Discount. What is the discount? When the market trades below the equilibrium level, we say the price is at a discount or low price. Note, when the price goes too low, it is more likely to turn up and head back to the equilibrium price. How do we identify a discount price? We wait for a market to move in a downtrend at a high degree angle. We then plot the swing high and the swing low to identify the 50% Gann box or fib levels. The market's price below the 50% is at a discount. Let's see that in action. So the market makes a strong move down in a downtrend. There is a prominent swing high and a prominent swing low, which you will plot the Gann box or the Fibonacci. So why Fibonacci? Because the Fibonacci also has a 50%. Get rid of all the other levels unless it's part of your strategy, but get rid of all the levels and just keep to that 50%. It's just to make life easy. I mean, you can do it with your eye and try and guess where the 50% is, or use a ruler. All I'm trying to establish is that when there is a impulse move down or up, or a fair value gap, there is an imbalance or inefficiency in the market that needs to rebalance, and the price will go back to equilibrium. So in this case, the market's price below the 50% equilibrium level is at a discount, and we expect the price to go back up at least 50%. So price went back up to equilibrium. Think of the elastic, if you pull too much, it becomes taut. And when it becomes taut, it wants to go back to equilibrium. And that's what prices do. And you can even see within here that there was a fair value gap that formed. Fair value gap, fair value gap, fair value gap, fair value gap. And every single one of those fair value gaps closed. Do you see that? Even this fair value gap, market went up, came back down, closed the fair value gap. And yet the market closed every single one of these fair value gaps. Not only did it go to equilibrium and go above the discount price, but it closed every fair value gap. So do you see how these things are all starting to tie within how it works in the market structure? So fair value gaps and discount. Wait for a market to form a bearish fair value gap. Plot the first candle's low and the third candle's high to identify the 50% Gann box or fib levels. So the first candle's low, we can see you would draw a line. The second candle makes an impulse or a bearish candle. And then the third candle's high, which you draw. And between that, that creates the fair value gap. Within the fair value gap, you can put in your Gann box or your Fibonacci levels. Below the 50% equilibrium level is discount prices. So we know that the price is going to come back up and at least close within those levels. So we expect the market price to go up. So it goes back up, sweeps liquidity, goes into the premium, closes the actual fair value gap, and that's how it is. Then let's look at discount versus equilibrium. So we can see there is a strong swing high and a strong swing low. You then draw the swing high and swing low with a Gann box or Fibonacci to create that 50% equilibrium level. You can see that there are a ton of fair value gaps that formed within the market. And then the market continued up, closed those fair value gaps, went past the discount level, and rebalance and created efficiencies. So what happens with smart money is that they want to buy at these discounted levels. They want to buy at the sell side liquidity. They want to sweep the retailers who sell, and they want to buy into those orders in order for the price to go back up. And that's exactly what happened. So we have those three levels. We have the swing high and swing low. Between that, we have the 50%, which is created through the Gann box or the Fibonacci. So the equilibrium is at 50%. Below 50% is discount. Above 50% is premium. Now we are at 6 elements to smart money concepts. So we've covered a lot of things today. There's a lot of new information, and it's a lot to absorb. And once you've absorbed it, once you've gone through the slideshow and the cheat sheets and all these elements, and you start seeing it with the analysis that I do every day on the Discord and the analysis that I do on Premium, because I am incorporating it slowly, smart money concepts into all of the analysis, it's going to make a lot more sense, and it's going to become second nature to your trading. It's going to get to the point where you're going to question, how did I not know about this stuff? Now everything is starting to make sense. This is why chart patterns form. So first one is daily buys. Which direction the market is in to trade? So are we looking at daily or are we looking at weekly? A bullish daily bias is when the market trend is up, you only look for longs. A bearish daily bias is when the market trend is down, you only look for shorts. So that's the first element, is go into your charts, go into daily or weekly or hourly if you're doing really short time frames, and then say, what am I looking for? Longs or shorts? Market trend is up, I'm looking for longs. Market trend is down, I'm looking for shorts. Then spot buy side liquidity or sell side liquidity. So bullish is sell side liquidity. Plot your order blocks. Remember I told you about those 5 different order blocks to plot and take a look at? Zoom out of your charts and plot them individually. Bearish buy side liquidity, plot your order blocks. All right, so take what you see when the chart's coming down at a certain level, draw your box all the way to the end and say, right, this is where smart money is going to come down, sweep liquidity and move back up, or smart money is going to come is going to go back up, sweep liquidity, and come back down. So step one, daily buys. Which way are you trading? Step two, buy side liquidity or sell side liquidity. Step three, draw your market structure shifts. So you know the market's going up, you know the market's going down. Now find where the market is shifting. So is there a break of structure? And if there is, there's going to be a continuation to the downside or continuation to the upside. Is there a change of character? Where is there going to be a reversal to the upside or a reversal to the downside? Then look at levels of liquidity. Draw them in the charts. So bullish levels of liquidity, look for resistances, look for highs, look for trend lines, look for key levels. Remember psychological levels, maybe 200-day moving average, maybe Bollinger Bands, maybe round numbers, maybe psychological numbers. Those are all key levels that smart money is constantly looking at. Look at a break of structure, look at a change of character, look at the equilibrium 50% and the bullish fair value gaps. Those are what you need to look at when you're looking at levels of liquidity. Bearish level of liquidity or bearish levels of liquidity, look for the support, look for the lows, look for the trend lines, look for key psychological support levels, look for the break of structures, look for the change of characters, the equilibrium 50%, look for the discount, look for the premium, and look for bare fair value gaps. Then box the equilibrium and fair value gaps. So if it's bullish, plot your swing highs, your swing lows, and put your equilibrium levels. So see where there is premium, see where there's discount, see where there's equilibrium. Find your bullish fair value gaps and make sure they're quite large. I don't personally like looking at small fair value gaps. I like big impulse candles to the upside, big impulse candles to the downside in order to spot equilibrium levels and also imbalances and inefficiencies. Then box your equilibrium bearish. So if a market is coming from the top down, then draw in your equilibrium levels with your Gann box, your Fibonacci levels. Draw your Gann box with the fair value gaps, the bare fair value gaps, so you can see where the market is more likely to go up and close. Then your exit levels. So this is your risk and reward. So with your stop loss, whether you go long or short, you need to look at the bearish or liquidity in order to your stop loss. With your take profit, you need to look with longs and shorts, look for bullish and bearish levels of liquidity, and always make sure this applies 100% to your trading. The risk to reward must always be more than 1.5. As you saw, I sent you the Smart Money Concepts cheat sheet. There's a long Smart Money Concepts cheat sheet, which basically outlines all of those 6 elements of SMC: the daily bias, the entry levels, which is above an order block, which is sell side liquidity, stop loss, supports, lows, trend lines, key levels. Now you know key levels are round numbers, 200-day moving averages, Bollinger Bands, maybe an RSI. I don't think smart money looks at RSI, to be honest. I think a RSI is good for looking at the momentum of the market and confirming the momentum of the market. But basically, you got to get into the minds of these big institutions. And they are not saying, where are traders looking at the RSI? I think they are saying, where are traders looking in terms of the 200-day moving average? When there is a psychological round number, what are traders going to do? They are more likely to place their stop losses around levels of psychological levels. Think about it. If a market goes from, let's say, 1 for the euro dollar, 100, and then it goes to 0.999, they'll say, you know what? That's the end of what? That's the end of the euro. That's the end of the euro. If it goes below 1, it's game over. So these are where they are, the big guys are looking for those levels to stop people out. And why are they doing that? Because they need the orders to fill in their own, whether they're hedging quantitative analysis, fundamental analysis, investing, value investing, growth investing, whatever they have for their idea, they are going to try and grab those orders and risk to reward for your trade to make sure. Look, if you have a risk to reward of 1-to-1, you need to make sure that your win rate is always above 50% because there are still costs and brokerages. So make sure your risk to reward is 1.5. That way you don't need a 50% win rate. You can even win with a 40% win rate. Premium levels. So make sure you base your take profits on premium levels on when you place your Gann box and your Fibonacci and the market turns up. And then rebalance fair value gaps. You want the fair value gap to close, to rebalance, to create that level of efficiency. And then the market will most likely turn back down or go back up. It's up to you. So these are ideas of how I'm going to be applying a lot of the smart money concepts into premium and also into the daily analysis. And whenever premium members ask me to do analysis for them, I'm going to incorporate not only the winning chart pattern strategy and the risk management rules, but also SMC, so that it'll give you a more idea of whether there is a high probability trade than not. The short smart money concepts cheat sheet, you also got this in your email, and you're going to look at the step 1, daily bias, the bearish daily or weekly. Make sure that it is in a downtrend or that price is below the 200-day moving average. The entry is below an order block or a buy-side liquidity. So remember, buy-side liquidity is high up, where smart money is going to grab those buying levels to sell into them, which is going to bring the price down. You then have your stop loss in place. So remember, the stop loss is always going to be above where you get in. And you're going to look at resistances, highs, trend lines, keys, break of structure, change of character, equilibrium 50%, bullish fair value gap. So remember, when a candle forms, a bullish fair value gap forms, and then the third candle, the market is more likely to come back down to rebalance the bullish fair value gap. And then take profit, look at supports, lows, trend lines, keys, look for risk to reward of 1.5, the discount prices, because when the market comes back down into the equilibrium to the discount, it rebalances it, and rebalanced FVGs. So here is an example with the JSE, where I was looking at the daily chart, and you can see that this is a very recent chart. And we saw that the daily bias was bearish. So I only looked for shorts. So how do I know that I looked for shorts? There are a few reasons. One, there are lower highs in the market. So there's break of structure to the downside, break of structure to the downside. There was a trend line. There were 2 trend lines, so this trend line was showing that there was a decent side to the downside, and then the inclination went higher, the higher degree that the price dropped. And so within this candle, I was saying I'm only looking for shorts. So then you draw your levels of buy side liquidity, which is what we did. Okay. We saw that the market price went up. We drew the highs, we drew the order blocks and the levels of liquidity. And we said that the market's going to come and test these buy side liquidity, come back down. Then you can see there was a test in the buy side liquidity where smart money comes, sweeps the buy side liquidity, the price turns back down, and we set our take profit levels at certain prices. Okay, so you can see there was a change of character after these break of structure to the upside. There was a break of structure, there was a change of character to the downside, went back up. You can see we're using a 15-minute chart. Some people even use a 1-minute chart. Look, once you are in the trade on a 15-minute basis, it's okay to watch the 1-minute chart to see how it moves. So it went down it crossed the buy side liquidity, swept liquidity. The price came back down. You can see there was a high degree angles of bearish fair value gaps that formed. Here's a bearish fair value gap. Here's a bearish fair value gap. Here's a bearish fair value gap. So it hit take profit 1. Now, what happens once it hits take profit 1? I bring my stop loss to break even and I close half of my position. Okay. Then I wait for take profit price to drop further. And you can either close another half position or you can close your entire position. In this case, I closed my entire position because there are fair value gaps to fill. The sell side liquidity came, hit my take profit, and this is looking more bullish because the price now has a greater inclination that it's going to go back up, sweep liquidity on the sell side. Smart money bought in, close fair value gaps, close equilibrium, go back to premium, and it had a higher chance at doing that. So you banked your profits. The market came back down, hit take profit 1, you moved your stop loss break even, you closed half of your position. No matter what happens, you will bank a profit. Came back down, hit take profit 2, you had a good day, or I had a good day. We will have a good day in the future when I plot all of these trades going forward, okay? Now we are looking at the Australian dollar, US dollar, which is the trade that I took. We can see there was buy side liquidity at this area. You can see that there was a fair value gap, which needed to close. So I got short at this level, went back up. I really thought the price was going to stop me out, just like a few pips. And then the market price collapsed, closed take profit 1. How do I know this is take profit 1? Because there were levels of liquidity of a low and strong liquidity over here. So for example, there was a cup and handle that formed, it broke above the structure, and that formed a level of liquidity. Then we look at the next levels of liquidity. There was a lot of activity that took place, and if you zoomed out of the chart, you would see that it was another level of taking a profit, and then it continued going down. So at take profit 1, you bring stop loss to break even, close half of your position, price continues dropping, hits take profit 2, close half of your position, take profit 3. You can close all of your position depending on how big your position actually is. And then you can see there was chop. And even when there was chop, the market came back up, swept the, filled the fair value gaps, went all the way up, tested that buy side liquidity again, and then crashed all the way down. I didn't take this trade. I didn't even look at this trade, to be honest. When you open your charts, we've come to the end of Multi-Traders Event Smart Money Concepts Masterclass. Whether you're a novice or an experienced trader, you're about to learn many new tactics you can apply to your trading with these multi-trader events. The Multi-Trader Smart Money Concepts Strategies and Chart Patterns SMC will be next. And during the event, we're going to go through the summary of the Smart Money Concepts. So if you attended this event, I'm going to do another summary in the next event. Chart pattern summary, chart patterns with SMC, a cheat sheet with SMC chart patterns, where to place your entry, stop loss, take profit levels, how to calculate how much to buy or sell with SMC strategies, real life trading SMC strategies, examples,